Hello, this is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. Today we're going to talk about the difference between the LLC and an S corporation. Now, first we want to start off about the similarities. First part is they both offer limited liability. This way it separates your personal assets versus your corporations. The second thing is they both can be passed through. Now, an S Corp is also always a pass-through entity. But in regards to an LLC, if it's just in your name or you and your spouse's name, it's considered a single member LLC and shows up on your sole proprietorship Schedule C on your personal taxes. You do not need to do a separate 1065 tax return unless you're in a partnership with somebody that's not listed on your taxes. And then the K1 is what that gets represented in. So the S Corp will always have a K1. Depending if you have a partner or not, you may not have a K1 on your LLC. Now let's talk about some differences. An S Corp has to have a salary, okay? Now, let me say that with an asterisk. If it's losing money, you don't have to do a salary. If it's making minimal profits, you most likely don't need a salary, okay? I know they're talking always about ideal salary. They call it reasonable compensation. But if you're not profitable, no salary is needed. With an LLC, no matter if you net $1 million a year, you don't have to pay yourself a salary. Why? The most important piece of the whole thing is that you have to pay payroll taxes on what you profit. If you profit $100,000, payroll tax is roughly 15%. So if you make $100,000, you're going to have to pay $15,000 of payroll taxes. That's how it works with an LLC, because it is a pass-through entity that hits directly on your taxes, unlike an S Corp. If an S Corp nets yourself $100,000, if you pay yourself no salary, you pay zero self-employment tax. You pay nothing into Social Security and Medicare. Now, I know what you're thinking. That sounds great, but the IRS is smarter than that. They're not going to let you net $1 million a year and not pay yourself any salary. So you do have to pay yourself reasonable compensation. A couple ideas there is typically the 1/3 rule. If you net $100,000, you pay yourself roughly $35,000 and have $65,000 come through a pass-through entity. That way, instead of paying on $100,000, the 15%, which is $15,000, really here you only pay $5,000 payroll tax. So you could save legally $100,000 in unnecessary payroll tax because you don't know what you're going to net from January 1st onward. So it's understandable you're going to have leftover money. Now, I know what you're thinking. What happens when you have money left over in the corporation? That's where a distribution makes sense. A distribution is just a withdrawal from the corporation. Now, you don't have to pay taxes on that because you already paid taxes on the whole net profits of, in this example, $65,000. So you paid no salary, and you netted $100,000, that $100,000 still shows up on your personal tax returns on a K1, which means in subsequent years, if you were to take out that $100,000, you don't pay an additional tax on that as long as there's basis in the company. This could be a fantastic way to save money on paying unnecessary payroll taxes. It doesn't make sense to pay yourself $100,000 a year if you're showing a loss of $50,000. You get what I'm saying? You're paying unnecessary payroll tax. If you have any questions, please reach out to us. Our information is down below.